Should you overpay your mortgage or max out your pension? It's one of the most common questions that I get asked as a certified financial planner. And on the surface, it feels like a personal choice, one that is about peace of mind. But on the other hand, it's about long-term wealth. But here's the thing. What feels safest isn't always what builds the most security, especially when you look at how money actually works here in Ireland. Because once you begin to dig into the numbers, you will be surprised. The strategy that feels sensible could be quietly costing you 6 figures, and the one that feels riskier might be your biggest wealth building opportunity. In this video, I'll break it all down. What overpaying your mortgage really saves you, what pensions can do with tax relief, growth and flexibility. We'll walk through a real-life client example to show you how the numbers play out in real life and help you see which option leaves you in the strongest position, not just in 5 years, but at retirement and beyond. So let's get into it. So first, let's understand how mortgages work. Most people don't realize that mortgage payments are structured through something called amortization, and this has a big impact on your decision to pay off your mortgage early or not. Let's put it into perspective with a real-life example. Imagine you take out a loan for €400,000 at 5% interest over 30 years. Over the course of the loan, do you know how much you'll repay the lender? €772,920. Yes, you heard that correctly. Here's the breakdown. $400,000 is the original loan amount, we'll call this the principal, and $372,000 is the interest paid back to the bank. So over the life of the loan, you almost double the original principal. So this is the power and cost of compounding interest working against you. In the early years of a mortgage, most of your payment goes towards interest, with very little reducing the actual loan amount or principal. As time goes on, this flips, and in the later years, more of your payment reduces the principal while the interest portion decreases. So for example, if you have a €400,000 mortgage at a 5% fixed interest, over 30 years your mortgage payment is about $2,150. In the first month, only $481 goes towards your principal, with the balance, $1,669, going towards interest. Now, let's fast forward to the midpoint of the loan, year 15 or a month 180. Repayment is still $2,150, but now a higher portion is going towards paying down the principal. $1,012 goes to the principal, which is more than double what it was in year 1, with the remaining $1,136 going towards interest. Making extra payments early in the loan term reduces the outstanding principal balance. Since interest is calculated on this balance, a smaller principal means less interest is charged in the future. So over time, this can significantly reduce the total interest paid on the loan. For example, let's say you decide to pay an extra €500 each month during the first 5 years. By doing so, you reduce the principal more quickly, which means less of your monthly payment goes towards interest as the loan progresses. This not only saves you tens of thousands of euros in interest over the life of the loan, but it also shortens the loan term, potentially by several years. In other words, paying extra towards the principal early allows you to reduce the time it takes to pay the loan and the overall cost. This is a simple yet powerful strategy for minimizing your long-term financial burden. Okay, so now let's flip the coin and look at what happens when you boost your pension instead. This is where the real magic happens, because pensions in Ireland come with layered advantages, and when used properly, they can massively grow your wealth over time. But first, let's clear something up. A pension isn't some complex investment scheme. It is simply a wrapper, a legal structure the government uses to reward you for saving for your future. You're simply deferring tax today into the future. So instead of paying tax at 20% or 40% today, you put that money into a pension and it grows tax-free. And you draw it out later on, ideally at a lower tax rate. This is the core principle. It is deferral, not avoidance. And that deferral comes with stacked benefits. So the first one is tax relief. If you earn over €42,000 a year, you're probably in the higher income tax band of 40%. So every €500 you contribute to your pension will only cost you €300. That is a 66% gain before a single cent is even invested. But this is an important part. That tax relief has age-related limits. So let's say you're 40 years old. You can contribute up to 25% of your income, capped at €115,000 of earnings for tax relief purposes. That's your ceiling for relief. So if you're already contributing that full amount through your payroll, extra contributions won't give you any more tax back. This is where a lot of employees get caught out. They keep topping up their PRSAs or AVCs without checking if they hit their limit. But if you're self-employed or a company director, there is a game changer. You may be able to backdate using unused relief from prior years. This means if you didn't contribute enough from previous years, you can now catch up and still get that tax relief. That is powerful because you're effectively turning old income into a tax break today. 2 is tax-free compounding. Once your contribution lands inside that tax wrapper, it grows tax-free. No income tax, no capital gains tax, no exit tax. Just uninterrupted compounding. Let's say you invest €20,000 gross today. Thanks to tax relief, that may only cost you $12,000 net. Assume a 5% annual return over 20 years. That $20,000 could grow to, say, $53,000. And remember, you didn't invest 20 at the beginning, you only invested €12,000 of your own money. So this isn't just growth, it's leveraged, tax-fueled growth. 3 is tax-efficient drawdown. At retirement, you can take up to 25% of your pension as a tax-free lump sum up to €200,000, and the next $300,000 at just 20%. And the rest after that, you draw it down gradually at potentially lower rates of income tax than you're paying today. So you get tax relief on the way in, your investments grow tax-free inside that wrapper, and you may pay lower tax when you draw it out. That is a triple win, and it's why pensions, while often misunderstood, are one of the most powerful wealth-building tools available in Ireland. Before we dive into the key decision factors, if you're unsure whether to focus on mortgage overpayments or growing long-term wealth through your pension, I offer free calls designed for business owners and high earners who want a clear, joined-up plan. We'll review your pension, your mortgage, your overall strategy, and bring it all together: tax, cash flow, retirement, and legacy. You'll leave with clarity and clear next steps. You can book it via the link in the description below. So let's say that you reviewed the numbers and you're swaying one way or another. But it's important to note that real-world decisions aren't made in spreadsheets, they're made in context. So let's zoom out and walk through 7 key factors that can influence your decision. This is where clarity comes in. 1. Your mortgage interest rate. This is your baseline. Your mortgage rate is the guaranteed return you get by overpaying. If your rate is 6% or more, paying it off gives you a solid risk-free return. But if it's closer to 3%, then your hurdle for investing is much lower. Historically, long-term investment returns will beat that. So putting your money into a pension, especially with tax relief, could give you a far better outcome. But don't stop there. 2 is volatility and risk tolerance. Markets aren't smooth, returns are lumpy, but mortgage repayments, they're predictable. If you can't stomach market drop, you may value the emotional certainty of paying down debt. But if you've got a long-term horizon and you understand how to ride out volatility, then investing for growth can reward you for that patience. Just don't compare guaranteed savings to theoretical gains without factoring in that risk tolerance. 3. Inflation and the real cost of debt. Now, this one is counterintuitive, but inflation can actually help mortgage holders. Why? Because your mortgage rate, if fixed, is in nominal terms, but your income likely rises over time and prices inflate. So you end up paying back your mortgage with cheaper future euros. Meanwhile, pension investments, if well allocated, tend to outpace inflation. So inflation essentially shrinks your debt and grows your retirement pot at the same time. 4 is prepayment penalties. This often gets overlooked. Some lenders charge if you overpay more than 10% off the outstanding balance in 1 year. So if you're planning to throw a lump sum at your mortgage, make sure it doesn't trigger a penalty. Remember, a 1% penalty on a €300,000 balance is €3,000. Always read the fine print, then do the math. 5 is the real hurdle rate. Here's the real test. If your mortgage costs you 3%, your pension needs to beat that after tax and fees. That means aiming for 5% or more gross, because in a 40% tax bracket, a 5% investment nets you 3%, which barely even breaks even. But here's the edge. Pensions grow tax-free inside their wrapper, so your actual hurdle rate is even lower. That's why pensions often win, even when mortgage rates are relatively low. 6 is liquidity and emergency access. Pensions are tax efficient but inflexible. Once the money is in, generally you're locked in to age 60 or 65, sometimes 50 if it's preserved PRSA or retirement bond. But there is no earlier access, no exceptions. Mortgage overpayments may feel more flexible, but unless your lender allows you to redraw, and most don't, that money is locked in. So what's a smart approach? It's to sequence your decisions. Build your emergency fund first, 3 to 6 months. Keep it liquid and accessible, and max out your pension if there's any room left. Only then should you consider making mortgage overpayments. It's not about returns, it's about flexibility, because real life doesn't always follow a spreadsheet. 7 is tax relief and employer match. This is where pensions really pull ahead. If you're in the 40% tax band, every €500 that you contribute only costs you €300. Remember that 66% gain up front? That is before markets even get involved. And if your employer offers matching, even better. A 5% match on your salary is a 100% return. It's free money and most people leave it on the table. So before even thinking about overpaying your mortgage, max your tax relief at least up to the employer contribution. Grab that match, then weigh up your options. These 7 factors don't give you a one-size-fits-all answer, but they frame the right questions for you to ask. Now, let's step away from the spreadsheets for a moment, because even if the numbers clearly say one or the other, most people still lean towards the mortgage. Why? Because paying off your home feels safe. It feels productive. It feels good. You see that balance drop every single month. You inch closer to owning your own home outright, and that sense of progress is tangible. Pensions, by contrast, well, they feel distant, feels abstract, maybe even confusing. You get a tax break today, but the benefit essentially is invisible. You can't touch that money, you can't see it grow, and you may not even access it for 15 or 20 years. So emotionally, overpaying your mortgage feels like doing something smarter, even if the math doesn't fully support it. And then there's a peace of mind. No debt, no repayments, just a roof over your head that no one can come and take away from you. For many people, that's worth more than an extra €100,000 in their pension pot. And that's fine, because the best financial plans isn't the one with the highest projected return, it's the one that fits you, your values, your comfort, and your lifestyle. So even though pensions may win on paper, don't ignore how each option makes you feel. You're not just managing your money, you're managing your behavior and your sense of happiness. So let's bring this all together now with a real life example. Meet Sarah, a 42-year-old management consultant living in Dublin. She earns €140,000 per year. She's already paying 10% of her salary into her pension through her work. That is €14,000 annually. Her mortgage is €350,000, fixed at 4% for 20 years remaining. And this year, Sarah has €20,000 in surplus cash. Now, her question is, should she overpay her mortgage or boost her pension? Now, let's break it down. Step number 1 is pension contribution limits. At age 42, Sarah is allowed to claim tax relief on her pension contributions up to 25% of her salary. But remember, that is capped at €115,000 of earnings. So 25% of $115,000 gives her a relief limit of $28,750. She's already contributing $14,000 through her payroll, which means she still has $14,750 of unused headroom. That's important because any contribution above that won't qualify for any tax relief. So to make the most of her surplus cash, she decides to put that $14,750 into her pension now. And we'll look what she might do with the remaining $5,250 in just a moment. Step number 2 is the pension advantage. That $14,750 qualifies for full tax relief at 40%. It means that it only costs Sarah $8,850 out of her pocket, but inside her pension, the full $14,750 is invested and growing tax-free. Let's assume it grows a 5% annual return over 20 years. That could grow to around €40,000 by the time she retires. That is a powerful use of her tax relief. She invests $8,850 net and she gets around $40,000 gross at retirement, all tax-free growth, and potentially a portion of that can be withdrawn as a tax-free lump sum. Step number 3 is to compare that to the mortgage. Now, let's say instead she used the same $14,750 to overpay her mortgage. With a 4% interest rate over 20 years, the overpayment would save her about $7,000 to $7,500 in interest and reduce her mortgage term slightly. $8,850 net equals $40,000 over 20 years. That's the pension option. And then $14,750 and a mortgage overpayment equals $7,500 in interest saved. So what does that give us? The pension wins, even before factoring in flexibility and liquidity. Remember, Sarah still has $5,250 of her €20,000 left. She can do a few things. She could put it into her emergency fund, if not already set up. She could overpay her mortgage, giving her some peace of mind. So what was the verdict? When Sarah saw all the numbers, she realized that pensions won out. She got the tax relief, long-term growth, tax-free compounding, and tax-efficient drawdown. With smart planning, she can still reduce her mortgage over time. The best use of the surplus cash, especially for a high earner like Sarah, is making the most of her pension first. So let's bring it all together. If you're a high-rate taxpayer in Ireland and you're not already maximizing your pension contributions, then boosting your pension beats overpaying your mortgage almost every time. Even if the mortgage rates rise modestly, pensions still win, thanks to upfront tax relief and the tax-free growth and the potential for lower taxes in retirement. And if your employer offers matching contributions, remember that is free money. You simply cannot beat that. But what if you're still on the fence? Well, split the difference. There is no need to go all in on either side. For example, if you clear your mortgage earlier, you'll reduce your monthly payments. That then frees up cash could be redirected into tax-efficient savings like your PRSA or your ABCs. Imagine your mortgage payment drops for €500 a month. That could turn into €500 a month in pension contributions, which only cost you €300 after tax relief. Not sure how to structure it? Here's a simple approach. Put 70% of your spare cash into your pension, but the other 30% into overpaying your mortgage or build up an emergency fund. That way you get the long-term growth, you reduce your debt, and you maintain peace of mind and flexibility. Because this decision isn't just about choosing right or wrong, it's about aligning your money with your long-term goals, your values, and your future freedom. Do you need help making the right call? I work with business owners and high-income earners across Ireland to build clear, tax-efficient financial strategies. We'll review your mortgage, pension limits, investments, and goals, and we'll bring it all together in one joined-up plan. Book a private strategy call using the link below. You'll walk away with clarity and a confident next step. If you found this video helpful, you'll definitely want to watch my next video. Should you pay off your mortgage or invest your money instead? It builds upon what we covered today and it shows you exactly how to run the numbers yourself.